All right, hello. Well, sorry it's a little late. It seems to be my story lately, but I wanted to run through some of the highlights, I guess, from chapter 9 and 10. So chapter 9 has a lot of information in there. Not a lot of it new. Most of it, if you look at the problems, were comprehensive type review problems. But in terms of the main things you want to get out of this is there's two things. One is what's the definition of a component unit? Okay. And then what's the reporting package consist of? And so it goes through what's in the Comprehensive Annual Report, or CAFR. And so you want to know those elements. And then, like I said, what's the definition of the component unit? And there's two methods. They call it discrete, where it's shown in a column by itself, or it can be integrated into the combined financial statements. It's where it's like another fund for the government. And so they talk about the criteria there, but I just want you to understand that there is some important criteria that you have to apply or know how to apply, and that's primarily control and financial dependence. And so financial dependence can take the form of guarantees for debt that's issued, as well as oversight for finances, like having to have the budget approved or having oversight of the budget. Not can you give recommendations, but something binding. And then the other part of it is, well, that's it. Yeah. Okay. So, useful information in the financial reports, and this is kind of a concept there, and it's recognition. So information shows up in the financial statements a couple different ways. One is through recognition, formal recognition. This is the same thing, that, the concept for financial accounting in the corporate environment is that, at the highest level would be where you actually incorporate it into the body of the statements. Disclosure in the notes is a secondary. So a lot of controversial issues that have arisen, like retirement benefits and post-retirement medical health insurance benefits, are gradually, they were disclosed because they are legal binding obligations, but they were gradually phased into the recognition of financial statements just because of the potential economic impacts of having those on debt covenants and other things. All right. And then there's supplementary information, and there's two categories: required and additional, optional. And what's the reporting entity? And of course, this goes back to the definition we talked about in chapter 2, and so you could review that. But typically the primary financial or reporting entity is the one that would have the combined financial statements, and other government, sub-governments, component units, and that are potentially a component of that. And there's some nice graphics and illustrations and examples in the textbook. But typically you have school districts, public enterprises, they're often enterprise funds, but sometimes like a hospital or a convention center is set up to look, to operate independently. They can have their own electric boards, but the primary government still has financial responsibility, and that makes it a component unit. Okay, and so that's the two primary criteria are right there, financially accountable and voting majority. So sometimes you get management oversight through direct appointment of their board members on these component units. All right, and so typically a component unit they're set up as a separate entity, and they can be a not-for-profit or a government subdivision. The University of Alaska is a component unit of the state of Alaska, and have a number of them. It can be also a for-profit entity. But at any rate, excuse me, the primary government still has financial and or management oversight, financial responsibility and oversight. And so there's this blended where it's integrated or it's discrete. And I think the city of Denver has examples of the discrete presentation. Okay, and then we get into the parts of the financial statement, the comprehensive report. And so there's these introductory sections and then the core of the financial statements. And so let's look at these. Well, table of contents, letter of transmittal, other materials. So this is like generally introductory level letter from the top government official, city manager, or if it's mayor, strong mayor form, they would be the person who would write that. And then the financial section has the auditor's report if they're audited. It's sometimes it's discretionary, but I would say 99% of government entities do opt to have an external audit. Management discussion and analysis, and then your basic financial statements, which include the government-wide and government funds, and there's budgetary comparison, and also a reconciliation between the government-wide and fund financial statements is required. And then we have a lot of supplemental information. So you've got a big section, and we'll see this and use this in Chapter 10, but you've got financial trends, typically 10 years, and then we break it down, revenue capacity, where do revenues come from by category, where's our expenses and expenditures by category, debt capacity, how much is our existing debt? Are we at a limit, statutory limit? How far are we from that? And then one thing that's unique to governments is there's a lot of demographic and information, and so you have a profile on the makeup, and a lot of this times this comes from census data, where it'll have median home size, median income, education, so forth. And that's important. We'll see in the next chapter for looking at demand for services, potential demand for services now and in the future. Okay. And of course, this is the reconciliation I alluded to. So you have to show the difference, and so these reconciliations are primarily because we don't have capital assets and long-term obligations in the government funds financial statements, and they are included in government-wide. We reconcile for those assets and the related depreciation, which are omitted. Okay. Chapter 10, we get into the analysis of, and this is really the meat of a lot of what we've been. We went through the mechanics and the different types of funds, so that really provides you the foundation not for just doing, but also interpreting this financial information. So I personally think this is one of the most important chapters in the book, and it's a lot to digest in, say, a week. We actually have this week and next week. Next week is governmental auditing, which is sort of a review for students that took the internal audit class, but it's also just kind of gives an introduction, overview of that process. Excuse me. Okay, and so not only are we going to look at financial reporting ratios that are unique to governments, we're also going to talk about some of the environmental and philosophical factors that drive, and economic factors that drive those performance measures. Okay, and so one of the things you have to do is be able to calculate this set of ratios, and there's two tables. 10.3 presents a set of ratios that are for the governmental funds, which is omits capital assets, it's modified accrual, and then 10.4, which is for government-wide, and it'll include measures of capital assets and things. So just keep those straight, and trust me, you're gonna get experience with those. I'm in class. I'm working the comprehensive problem at the end of the chapter, or the financial analysis problem at the end of the chapter, and I'll share that with you guys separately. But the midterm exam is going to have you apply those ratios to a small government in Alaska, and I'll have that out Friday on Blackboard. So anyway, we have these concepts of financial position, which is a kind of a cash, real short-term ability to meet our obligations. Financial condition, which is a little bit longer than just the capacity, as I say, to meet financial and service obligations in the near term. And then economic, which is a real broad concept, and it's not just economic ability, the financial position, but willingness to meet these financial and service obligations. And this just kind of shows they different concepts, fiscal capacities, ability to raise revenues to provide services, and the service capacity that we have. And again, socioeconomic demographic factors will drive the demand for these things, as well as the ability to pay. Higher education typically results in a stronger economic base, economic level by our citizens. It's very strong in attracting industries and economic development. Characteristics of your community make it attractive to people, right? To raise families and to settle. So it's a lot of factors. And then we get into some of the ratios, and so these are the ones that we are going through in the last problem in the chapter. So unrestricted position, what unrestricted net position is, our like equity, if you will. And It's the cushion we have, and it's scaled by revenues. So in terms of our annual revenue amounts, how much do we have sitting in unrestricted net assets right now? How much cushion? Capital asset condition, this is accumulated appreciation over average capital assets. So where are we at in the lives of our capital assets? Are we, if it's 50% or less, then we're not, we're still in a good position. If you get above like 75, you're looking at making some major replacements in the near future. Debt to assets, that's a similar measure. Sometimes you see in corporate debt to equity, but they're all related. And we've got these liquidity ratios, current and quick. The change in net position. So what happened from this year to last year in terms of our surplus or deficit of revenues over expenses? Interperiod equity. I've talked about this. Is real important. Where are we at with respect to interperiod equity? Are we meeting our current obligations without having to borrow money to meet those service commitments? I think a lot of people think that having a lot of unrestricted net position or fund balance, equity in the government is a great thing. But I encourage students to think about it in a different light, in that if you're a member of that community and you're paying taxes, nobody wants to pay more than they have to. And so when you're running a surplus of revenues, that suggests that your tax base, your tax burden is higher than it needs to be. And citizens at some point will say, why are you accumulating these resources? Give us some tax relief. And I concur with that. And then there's sales tax growth, and we have a number of measures of revenue sources that we'll look at. Revenue dispersion, and that's the next one. How much is within our control, like property and sales taxes, and how much is outside? Investment income, capital grants, and operating grants. Those are things that are nice to have, but they're not within our control. Okay, and then debt per capita. It's amazing when you calculate this for some communities. I think Illinois and Chicago primarily has a huge debt burden. I mean, it's just unbelievable, as does the federal government, right? Debt limit we've talked about before. It shows a measure of flexibility. If something happens and you have to borrow money, or you want to expand services, make investments, so to speak, in capital infrastructure, this is where it typically comes from. And then what's our tax per capita? What's that burden? The sales tax rate. And so the last part of this is, after we calculate these ratios, the interpretation is equally as important as being able to calculate the ratios. And so it's real important to understand how they fit together. All right. Well, sorry again that this was late, but we're done.